Hello, I'm Steve Balch, the Director of Wealth Management and Financial Planning at Certa Financial Planning, here to give you our market update for May. The macro update continues to be the same for now, but we are watching to see if changes are needed. The market trend continues to stay positive, even though the market broke below its 50-day moving average and had its first negative month in 5 months. Overall, though, the trend continues to be upwards and continues to stay in the positive upward trend. Fed policy continues to be neutral as the Fed continues to hold the rates where they are. This neutral stance may end up being the stance all year as the market has adjusted from 7 cuts to just 1 now after another hot inflation reading last month. Fiscal policy continues to be a positive. There seems to be no end in sight for the spending in Washington. This is not great for debt, but it is keeping the economy moving. Economic leading indicators continue to be positive as well. The job market was strong with March adding over 300,000 jobs. However, the April report came in below expectations, making this just the 4th miss in the last 25 months. There does appear to be weakness in full-time employment and the private sector, but overall, the economic data continues to hold strong and the consumer continues to spend. From a valuation standpoint, we continue to stay neutral as valuations around the world continue to be attractive while the US market continues to be expensive. In the market regime, we have seen a change in this regime as we've moved from Goldilocks to reflation. This regime happens when inflation and growth are both increasing at the same time. The good news is this is still a risk-on environment. From a business cycle, we continue to stay in the late stages, but we have moved back in the stage as there have been signs of stabilization and even reacceleration in some areas. Recession risks continue to be moved back. These are the 3 questions we're monitoring going forward. The market pulls back, now what? Is 1 the loneliest number? Sell in May and go away. The 5-month S&P 500 win streak ended in April when the S&P 500 had a negative return. Unfortunately, all good things do have to come to an end, but that doesn't mean all news is bad. Pullbacks and negative months happen. Strong positive returns in the markets need breaks. Looking ahead, when previous 5 months win streaks have ended, the following month is a mixed result. However, the 3, 6, and 12-month outlooks show above average returns. In fact, a year later, stocks have been higher every time, 6 out of 6 times. Is 1 the loneliest number? As discussed last month, the market expectations of 6 to 7 rate cuts to start the year have dropped drastically, and the potential for 0 was rising. After another strong CPI report for February, the market has taken their expectations of a June cut off the table and lowered the expectations to cuts of 1 for 2024, occurring in September. Additionally, rising inflation to start the year has raised concerns about the next move being a hike, but the Fed nixed that idea at the April meeting. A weak job report for April caused a market rally on Friday in hopes that the Fed may cut sooner than September. For now, the Fed continues to hold as they assess inflationary data, but it seems like the expectations of 3 or more cuts are rapidly declining. Sell in May and go away. The adage is sell in May and go away. The next 6 months are historically the worst performing months for the stock market, averaging 1.7% return and moving higher only 65% of the time. However, these worst 6 months have gained in 8 of the last 10 years, and the S&P was up 9 of the past 10 years in May. Additionally, election years tend to see a summer rally and strength during these 6 months, with May through October period higher almost 78% of the time. What stands out in election years is usually October being weak as election jitters cause concern. Our positioning and our outlook. So what does it all mean? In the beginning of April, our internal models shifted us to a neutral stance on growth strategies, causing us to reduce risk in portfolios. We continue to stay in the neutral stance, but are watching for potential shifts as market sentiment may be shifting to bearish. As you can see in the chart provided, weakness at this time of the year in election years is normal. Historically, when the election year starts strong in Q1, like we just saw, April and May tend to be weak, with stocks typically bottoming in early June before we see a summer rally. So far, this year is following the historical script. For now, we continue to follow our process and adjust as needed. We thank you for watching. As always, please feel free to forward this to anyone you believe can benefit from the information. If you have any questions, please feel free to reach out.